Hey, how you doing, everybody? David Skarika. So we're gonna do a little two-parter today because I don't want to bother. I'm feeling lazy. I'm not gonna edit these. So it's about 4 o'clock. The market's just closed. So I came down to just take a walk on the beach here, and obviously we're on Surfers Beach, which you've seen many times. Low tide, so you see these rocks and stuff. So there's that hurricane. I think Gabrielle's out there. So that's what we got a little more. And even though those things, even if they're hundreds or thousands of miles away, they do kick up the ocean and the surf. So, anyhow, so it looks like we're going to be okay for hurricanes this year. There's going to be a small system that's going to just miss Eleuthera, according to the European and GFS model. And that will happen actually about the time of my birthday, this weekend, early next week. And then there's another larger one that in early October it's going to go way out into the Atlantic, and there might be something going on in the Gulf. But yeah, you already feel like we're past the peak. The peak of the season is kind of that second week of September. So now we're kind of, if you look at the number of hurricanes, major hurricanes, even just smaller hurricanes, it really starts to collapse into late September, and by mid-October usually you're home free, right? Usually, because in October and so around Halloween of 2012 was Sandy, and Hurricane Matthew hit Nassau at the end of the first week of October. But I think we're going to be okay this year. So anyhow, okay, so the markets, I think we're finally nearing a correction. First of all, I'll just put a chart. I'm going to put a shorter and long-term chart, shorter-term and longer-term chart of the S&P 500 under this. And the way that it's gone up, there was a kind of V bottom after the Trump tariff tantrum, and then it's kind of like had a slower pace of increasing after that first month of like that V. And it's unsustainable. Now, it did have a rally like this for about a year and a half, or a year and I guess 8 months after COVID in 2020. But you have to understand, then they cut rates to zero. They're printing trillions of dollars. So that was a massive risk-on rally. I know they're going to cut rates, but they're definitely not going to money print, right? Like they did then. And now, right? So yeah, that's so like that. Yeah, they're just not going to do that, right? So that's just not going to happen. So yeah, I think we're going to see. It's just impossible for the markets to keep going up, like a no volatility, no pullbacks. We finally had a down day in the S&P. So the question is, how do we top? Do we see a bear market from now to the end of the month? Like, I know that's only, or end of October or mid-November, I know that's only 2 months, but that has happened before. Do we see kind of like 2000 and 2007? Is this the first crack that's about to happen? And that would be like a 15% or so downturn. And then probably the Fed would come in more aggressively. And especially if that was met with some kind of credit problem. And I'll tell you about the catalyst I could see for that. Or is this just a correction like 1999 or 2020, where you're in the bull market, you get a 5-10% correction that fall, and then the market continues to go up to like the new highs, right? So we have to ask ourselves, which one is it, right? So I don't know right now. All I know is I do have some shorts. I just put on 2 new put positions. They're actually companies that report this week and industries that I think are weak. So I added a couple short ETFs. I'm probably about 15 to 20% short as a hedge in the ETFs, and then I've got a couple percent in puts, which I would probably blow out, in mid to late October, probably late October, just over a month away if nothing happened. But I just think, the way this market's been increasing, and everyone's looking for this catalyst, the Fed rate cuts. But I think the problem is, you look at the 10-year bond isn't going down in yield. 30-year mortgages are now like a quarter of a point higher than they were last year after 4 Fed rate cuts, taking 100. Those are 3 rate cuts. I think the first one they did in 2024 was half. But anyhow, after 100 basis points of rate cuts. And the problem is, I keep saying, is I think that long end is, the problem is, quite frankly, there's just too much debt. So investors are asking for more return on their money and not getting really want to buy the long end. Like, why would you buy a long-term bond yielding over just 10-year bond 4% when it from a government that's 100 and 25% debt to GDP, right? 125% in debt, has a debt to GDP of 120%. You know, so anyhow, man, I'm watching this guy paddleboard. He's really good. So why would you do that, right? So that's the kind of question in the end. So so the catalysts I see really 2 main things that can happen to the markets here. And you know what? We'll leave that for part 2. We'll leave that to part 2 on the Caribbean side, which I'll be doing probably. You'll see it right afterwards, but in about an hour. So there you go, part 1. Luther Island Shores, that's the name of the area, also known as Surfers Beach. Beautiful day. And I'm gonna do a little more. I'm gonna do about another, I'd say 10 to 15 minutes this way. I'm walking for about a half an hour on this beach. This is a very duney beach, by the way, so the walk is a little tough.